Thank you, Alex, and of course the trading team, the whole team there for having me on this webinar. So, guys, how's everyone doing today? Let me just drop a quick hello on the chat. Please make sure you write all your questions you may have along the way. I will try to answer them on the go or at the end. Today's webinar, I believe it's going to be one of the best webinar, in my opinion, in terms of break down a few things and go straight to where we have to look at the root of trading, especially trading with prop firms. Okay, because there is a little bit different, twisted mindset, I would say, and we're going to explain things along the way. Just as usual, our disclaimer, just to ensure that everyone understands that this content is for general information only and is not intended to provide trading or investment advice or personal recommendation. And for those who see me for the first time, my name is Theo. I'm in the industry for more than 11 years now. I'm a certified financial technical analyst. I hold certifications as a market technician by the International Federation of Technical Analysts, as well as the Society of Technical Analysts in the UK. I do specialize in currency trading, in currency correlation, and I can say I pretty much spot quite accurately most of the times, not all the time, the correlations between the major economies when we have news, and especially the last couple of years with the non-farm payrolls and the ADP and all this stuff, but we're going to see them along the way. Now, besides the trading activity on a daily basis, I deliver content for the trading pit in our blog about the market analysis on a weekly basis. Every Monday, you can visit our website, go to the blog section, and you can read all the most tradable instruments here at Trading Pit. And many people, they know me in the industry for doing interviews with Steve Ninson and webinars with John Bollinger, the founder of Bollinger Bonds, Daniela Kalle, and many, many, many more. Okay, so guys, today's agenda, it's something we touched pretty much just a little bit on the previous webinar, and we explained just briefly about consistency. Okay, now, the second thing we will touch on today is the market phases, the APD and the DPA. I will explain later what these are, and I will give you like a takeaway, 2 solid strategies that I trade for the last, I will say, 10 years. Okay, I don't deviate from my trading strategies and from my trading rules. It's just simple rules that I follow day in, day out. You can apply them in all time frames. So just please stay tuned. If you need to grab a pen and paper, just feel free to do that. So now, why traders fail when trading challenges, when taking challenges with prop firms? I would like you guys to understand first. Let me ask you this. Do you guys see when I use the drawing tool, the screen annotation? Can you please write a quick yes or no just to make sure? I draw a cycle here. Can you see when I'm pointing on the chart? Because it will be important. Okay, I assume everyone can see. Yep. So the thing is that there is not a single reason, guys, why traders fail when trading challenges, when they purchase the challenges. It's a combination of things. Okay, traders usually, most of the times, they are looking to find the reason, and they want to find the solution. Of course, we want to find the solution, but most of the times, the reason behind something we do in trading is not directly where the problem is. We have to go a little bit to take a little bit different direction in order to find and solve the issue. Okay, now among these facts, the top 3 on the list is the traders lack an understanding of the market, and then they lack understanding of time frames. What I mean by that, a market that moves like this and it's in an uptrend, and a market that moves like that and it's in a downtrend, it requires different mindset and different approach to be trader on different time frames. I often coach traders, and it takes a bit of time to flip their mindset. Like, they trade on the 1 minute time frame and they trade on the 1 hour chart. You look these time frames in a little bit different way in terms of execution. They need different approach. So understanding the difference between the time frame you are interested to execute your trades, it's a major factor for moving forward in your trading and get comfortable with trading. And of course, different markets, they behave differently. And because if we take an example, the Forex market, if you're going to trade, guys, the Australian dollar, AUD, USD, and if you're going to trade the Swissy, USD CHF, they behave differently, they move differently, and during major events, they have a different character, these pairs. Okay, so a bit of understanding of the market we are interested to trade, it's also a major factor. And the last thing, which in my opinion, it's the most important, and it's the number one thing you have to pay attention to, traders, is that many traders, they are motivated by factors they cannot control. But pay attention to that, guys, please. These factors we cannot control, it's the primary reason that we are trading, isn't it? Think about that. We cannot control where let's say we are buying market, let's say Euro USD moves upward, we find out that swing low, confirmed swing low appeared here in any time frame, regardless of our strategy, anything, we enter here, we have a stop loss, let's say below the swing low, and then once the market moves in our favor, the greed kicks in. So how do we deal with the greed? Well, how much it's enough? Is it, if we take profits at 2-to-1 reward to risk ratio, are we going to be upset if the market keeps rallying? Or if we're going to take partial, we want to take partial position, we're going to close the position. When I say about profits, about money, I'm always referring to virtual money. Okay, here it's the risk disclosure at the bottom for those who might need to understand it a bit better. So would you be upset that you leave behind position on the table? Or if you are on one-on-one, if the trade is on one-on-one and then it starts moving against your position, would you be upset that you didn't close the position? And if it comes to the entry, you're going to close the position manually because you don't want to experience a losing trade. And all these, they are playing with in our mind while we are trading. So the only thing we cannot control, and that's when we're going to take profits or how long we're going to stay within the trade. If we're going to go for 1-to-1, 2-to-1, 3, 4, 5-to-1, it's the primary reason that we are trading, right? But instead of focusing here, we must become skillful and excellent traders on managing how much we are willing to bet on each and individual trade, stop loss placement, take profit placement, what will be the ideal position size. We explained about the position size on the previous webinar. If you missed it, you can refer back to that. Okay, oh, sorry, I pressed wrong button here. So, so remember to understand that what you cannot control most likely drag you in the market at first point, but the focus has to be shifted from there. Okay, that will be the end product of the process. And briefly, I made a small introduction about how to become consistent, but today we're gonna go deep on how to really build consistency in trading. And on the last webinar, we explained that by doing the same thing, and that's the first chain, the first part of the chain, repetitively, okay, we are building the trust that allows us to feel confident, and confident will lead to consistent. Okay, but there is a gap always. The chain is broken, ladies and gentlemen, right here. This part is broken. There is a gap. Let me explain what I mean by that in the next slide. So, where is the problem, guys? The problem is between doing the same thing over and over again and to build up our confidence. And the problem is the trust. That's the word you need to really understand. I'm sure everybody knows what does it mean, but we must build trading trust to lead us to where we want to be. Trust, it's our boat to cross the island. Trust, it's our vehicle to move from point A to where we want to be at point B. But in order to go to point B, the only way is to build the bridge between repetition and confidence. And that comes down to trust. But how can we build this repetition? Okay. And how can we get ourselves to trust our process? We have to understand few major factors. First, we have to understand that trading, by definition, it's a different world from the world that we are used to live in. And I'm sure if you trade just a little bit or a few months, let's say, and you grasp some idea about trading, you understand what I mean by that. So we have to become conscious of few things, guys. Okay, the first thing is that, as we mentioned earlier, the time frames are important. Each and every one time frame, guys, reveals different information. Let's say you are looking the 4-hour chart of Euro US dollar, and the market moves upward. At some point, you identify that it's a weekly level, let's say weekly resistance. Okay, and you want to trade short, for example, on the 15-minute chart or 5-minute chart, doesn't matter. If you go down to the 15-minute or 5-minute chart, this move, let's say from here to there, it's going to be a dynamic, a robust move to the upside. It's going to be a solid uptrend. How do you build up that understanding and the confidence to go short against the prevailing market trend? Okay, so there are few things we have to consider on this one. But the problem, and where traders find it hard, is sometimes they pick up, let's say, a short trade from resistance, and let's say on the euro US dollar, and it works. They short it and they go for 2 to 1 and it works perfect. And sometime, let's say 5 days later, the market comes back, the same currency pair, euro US dollar, at the same level with the same price action or same setup. They execute the trade and they get a losing trade. So what happens then? Then traders, they experience this. The trust is the chain with the trust is broken. They lose trust on their what? They lose trust on their trading plan, the second point. So how can you feel confident to continue doing the same thing, which means executing the same strategy, let's say in the same, under the same market conditions or different market conditions on the same currency pair, and one time the trade win and the other time the trade lose? So this is what traders always battle within their trading. They expected that because it's a good trading plan and because they understood well, let's say, the time frames, and a subject we want to touch on next week, it's going to be time frame correlation, and that's also a crucial webinar, guys. They do expect it that all the time they're going to experience the result they want to experience, winning trades. So the question now comes, if I don't believe that the trade I will put on, it's going to win, so why should I put on a trade? That's another thing, right? Trading a trading plan instead of any impulse or retracement the market offers, it's what's going to separate you guys from the crowd, from people that they see a move like this and they buy, or from people they see a consolidation like that, we're going to buy, or here we're going to sell. There are traders out there that we trade a trading plan. We don't trade the markets. We fit the market conditions into our trading plan, and if the conditions and if the parameters apply, then we take the trade. But the most important is to have the trading plan. That I'm going to give you 2 trading plans today. Okay. And what you have to understand and really accept it is that a high probability setup can end being a losing trade. A high probability setup, guys, not a low probability setup. A trading plan that, let's say, has 4 parameters that I will show you later, one of the trading plans. And you tick the first, let's say you are looking for, do I have support? I want to buy, for example. Do I have support? Yes, I do have support. Is there a price action, bullish engulfing or hammer? Yes, there is. Maybe an oscillator, RSI or stochastic, bullish divergences. Yes, there, bam. And do I have enough room, let's say, for reward to risk? 2 to 1, for example. Yes. Everything sounds like it's the ideal setup. But in trading, ladies and gentlemen, you have to accept the fact that a high probability setup, it can also end up as a losing trade. And a low probability setup that some of the parameters, let's say, don't match to take the trade, after some time we go back and we observe, we see the chart, and it was a trade that gave a winning outcome. So at that moment, the traders, they start feeling upset, they're feeling angry, and what is again where the problem falls is to this part of the chain, to the trust. They lose trust of their trading plan. But by not having trust on your trading plan, you will not take trade all the time when they appear. So you will never feel confident to execute the trade, regardless you are not always sure to get into the trade. So consistency, it's going to be something that will always be missing. Okay, guys. Any questions so far? Please let me know. So remember, it's all about trusting your plan, but the path to trust your plan is to do the same strategy over and over and over again. At least do it for 100 times, see the results, and then you decide if you're going to have, if you want to change your strategy or not. But without repeating the same strategy, you won't find out how you feel, if you feel confident about the strategy. And when you use softwares or you look back on the charts to backtest things, in my opinion, that's another thing we can touch in another webinar about backtesting, because I know many of you guys are looking to backtest to build the trust. But again, the backtest always has some parameters that they're going to be missing from your real trading. And I will give you an example. If you are taking manual trades, I'm sure that everyone needs some answers about backtesting. But what's the issue with backtesting? Let's say you are a trader, lives in Europe, and you are a trader, trade NASDAQ, okay, and yes, and you are trading, let's say, from 4 p.m. Cyprus time, or sorry, 2 p.m. UK time, 2 p.m. UK time, until 6 p.m., let's say, UK time, and you're trying, and 5 p.m., sorry, and you're trying to find some trades while the New York trading session is active. If you backtest the NASDAQ and you can filter out the exact time frames you are trading, then in the backtest results, they're going to be included trades that open and closed during the Asian session, during the Sydney session, perhaps, prior, during the London session or European trading hours. So there will be data that won't reflect the your actual trading activity. Okay. Is that okay, guys? Do you understand this? Any questions you may have? So next one, what is the APD and the DPA? It's something that you need to pay attention to in order to understand how the market operates and how you can fit and where you can fit your trading plan, under which market conditions, under which market parameters and what market behavior. So The APD refers to accumulation, public participation, and distribution phase, and the DPA to distribution, public participation, and accumulation. So the first one refers to what we call an uptrend, and the second one refers to what we call a downtrend, guys. So accumulation is the area on the chart where the price moves most of the time sideways. And I ensure you go down to the 1 minute chart, you go down to the 3 minute, to the 5 minute, to 10 minute, to 1 hour, to 4 hour, to 1 day, you will find areas of accumulation. Then the public participation phase is when the when the imbalance of buying and selling pressure is obvious. It's when the market takes over and we see impulse candles that move upwards and upwards, and the market gets stronger and stronger. So if you check again to any time frame, you're gonna find a time and moment on chart where there are strong bullish candles. We are talking about the APD phase. And then it's the distribution when the market decided that it's gonna stop moving upward and it's time to take a rest. Now, with the distribution, sometimes this part acts as a continuation pattern, and the market moves sideways for a noticeable amount of time, and then it continues for a final phase, let's say, to move upwards. Or in many occasions, after the distribution, we go back to the selling phase, and we go opposite. Then it's a distribution, then it's a public participation, and then the price starts to accumulate again to move upwards. Okay, so there are different ways to trade different market conditions. Now, if you trying to trade if you are a trend trader and you're trading trending, let's say, strategies, and you try to trade the trend while the market is accumulating, you're going to experience frustration. I believe so. Why? Because during the accumulation phase, the market is in an equilibrium. The market is not moving upwards. So if I try to use trending indicators like Bollinger Band, for example, or moving averages. Let's use moving average because we keep the Bollinger Bands also for ranging markets. But if we try to use the moving average, which it's a clear trending indicator, then definitely all signals we will get in the accumulation phase, they're going to be wrong. So if we decided that we want to trade trends because it's simple to trade the trends, I'm not saying it's easy, but it's a simple trading strategy itself, we have to focus when the market is on the go. When the market is really moving upward, we identify that, okay, it was a sideways move, the market broke to the upside, then we're going to apply our strategy here to trade the trend. So understanding how we use the market phases is crucial for our trading positive results experience. Okay. Now, if you're trading kind of smart money concept of Wyckoff strategies, then most likely you want to participate in the accumulation phase. But again, for how long you're going to keep the trade open, it's something you have to also decide before you're going to enter. I often see traders, they use this concept, they try to get in, they are in the trade, they immediately move their stop losses to break even because they don't want to be wrong or to lose on the trade. The market moves in public participation phase. The market broke outside, and they, instead of hold the trade, because that's where you're going to experience the great results when the market moves, right? So you have to understand that these are phases, that's how the market operates, that's the mechanics of the market. And then it's the distribution. Often traders, they try again to apply any kind of strategy while the market is about to, let's say, reverse or to go to a sideways move before it decides if it's going to move upwards or if it's going to push to the downside. So let's try to understand a little bit the accumulation in both occasions, public participations, and the distribution. As for example, here we see the Great British Pound USD on the daily chart. That's a picture that I put here. In this rectangle, the market is accumulating. Okay, here I have the 20-period moving average. It's a simple moving average. The market, it was in a downtrend. It made a fresh low. We see that the selling pressure wasn't that strong compared to the selling pressure here. And then the market moved upwards and come here. This it's a great example of, if you guys are trading Wyckoff method, that applies really, really well. And the market at this point here, it's in the accumulation phase. Now, do we know for sure? And that's the crucial question, guys. Do we know for sure that this is an accumulation phase? The answer is no, we don't. But based on some oscillators, momentum oscillators like the MACD or like the RSI, we spotted bullish divergence or positive divergences, and the probability of this market currently to be in the accumulation phase is high. So we have two options here. If we trade Wyckoff or smart money concept, we can take positions within this accumulation based on our strategies that we find they work for us. If we are a trend traders, we understand that maybe soon we're going to have a trend. We mark our rectangle. After the breakout, we start looking for entries. One entry was here, cross and not sustained below the 20-period moving average. Another entry was here, bullish engulfing. Another entry was here, bounced off. Another entry was there. So we don't need too much in trading. We just need some solid setups here. Okay. Next one. This is the Australian dollar, US dollar. Remember, I explained at the beginning that different time frames they offer. They have all this stuff. Okay, you can find everything in any time frame. You just need to put some boundaries. You just need to set up some boundaries or what you really want to trade and what type of trader you want to be. So Australian dollar, US dollar, the hourly chart. Here, the market was moving sideways and it broke to the downside. So that was the distribution, then public participation, and at the bottom, it started the accumulation. Now, at some times, the market accumulates for a little bit of time. At other times, it accumulates for longer time. Now, that's another subject to explain why this happened here. There is a very, very solid explanation, but it's not for this webinar. I will come back with another webinar and go deep on this stuff and explain them. Now, for last, as I promised, we're going to give 2 strategies that you can use them. Feel free to use them in any time frame, guys. They work pretty well. You can use them, you can twist them, you can try them and see how they work for you. As I said, different types of traders, different personalities. The way I trade may applies to 100 traders, may not apply to 20 traders, or vice versa. We are all humans. We have different beliefs. We have different perspectives. We have different risk thresholds. Okay, we have different level of greed, of fear. All the emotions are different. So when we are trading trends, there are few parameters that they make a trade as a high probability setup. One of these is we look to trade if we are going long. We look to take trades while the price is at support. Now, again, if you are trading on the daily chart and you are drawing your supports on the 4-hour chart or hourly chart, that's going to create a bit of mess in your trading because the zones won't be relevant. On the other hand, if you're trading on the 5-minute chart and you're drawing only support and resistance on the daily chart, again, it's going to mess with your trading. So you have to look to draw your support and resistance, let's say one time frame above the time frame you are taking the trade. So if you are executing on the 15-minute chart, you're going to look to trade your support resistance, let's say on the hourly, maximum 4-hour charts. Okay. Next one, you can look for trend line or moving averages. Usually the markets, they move in nice sequence. When they trend, you have a high that is higher than the previous one, so we have a higher high, and then you have also a low that is higher than the previous one, so you have a higher highs and a higher low. Now, most of the times we can draw a nice trend line, an upward trend line, if we are looking to buy. Some other times when the market is really on a go, like the indices, for example, currently, the moving averages will capture better the retracements. Okay. Then you can combine this with Fibonacci retracements. The lower the time frame you go, if you go on the 1-minute chart or 5-minute chart, the market usually, because of the high volatility, especially these days, they tend to go far and beyond the 61.8%. So the 78.6% of the Fibonacci ratio, it's also a good one. But trading on the higher time frames, for example, 4 hours daily charts, 1-hour chart, once you spot a trend, the area between 50 and 61.8, they usually offer great setups. And once all these they are in alignment, you can look for a strong price action reversal. Remember, if you are trading an uptrend, guys, you want to enter long on the retracement. So if, let's say, here it was previously an area of support, and you can draw a trend line or a moving average can fit well, and at the same area a Fibonacci ratio is also present, then we can wait for, let's say, a hammer or a bullish engulfing or train tracks, bullish train tracks. Bullish train tracks are candlestick formations that they have equal highs and equal lows, not necessarily equal bodies, but equal highs and equal lows. but most of the times they have also equal bodies. And that's a strong reversal price action. So all these parameters apply, boom, we execute the trade. This is a simple and robust trading plan. You can try it, you can see how you if it fits for you, okay. And trust me, you're gonna understand the markets really good, because trading one thing until you master it, it's a very important step to close that part of the chain that called trust, and that will lead you to consistency. And by saying consistency, it doesn't mean we're not going to experience losing trades. Okay, we will just simply be okay with the results. That's the major part. If the market now, the last strategy, if the market is moving sideways in a range formation, like we can identify a resistance as well as a support, we can, let's say we want to sell. Do we have a resistance? Yes, so that's ticked. We can check an oscillator for divergences. We can check the RSI. Maybe the price makes equal highs, but the RSI makes lower highs. So that's a signal that this last impulsive move, it occurred in a lighter volume without need to check the volume. That's what we understand, that the market didn't really move in that power from this point to that point. So we see the divergences. If you want to use Bollinger Bands, and you can use them, for example, because many traders and many algos out there, they are using the upper and the lower here. Okay, not the upper. That's the lower band. It's just a typing error. So price bounce of the upper bar, we are looking to go short. We confirm with a price action, either bearish engulfing or shooting star or bearish train tracks, and it's going to be also a very high probability trade. You can take screenshot, you can write this down, you can try it, and I'm sure at some point you're going to gain much better understanding of what type of trader you would like to be. Okay, we can talk about this for hours and hours, because there is also the one thing to say after that, and then another thing. So it's a whole different different subjects. Okay, so guys, that's all from me today. I really, Alex, you there? I really and I want to believe that we add enormous amount of value in your trading knowledge. There are things, every trader is looking for answers for this, for that. And I remember that at some point I was also participating in webinars because I was needing the answers. And that's the way to go. So again, guys, thank you so much for joining us here at the Trading Pit. Remember, if you have any questions, you can message Alex or myself, and we will be very happy to answer all your questions. So myself, the team of Alex, the team of the Trading Pit, would like to wish everyone to have a fantastic day ahead. Enjoy your evening, and we will look forward to see you on the next webinar, of course. And remember to visit our website for the to read about the market analysis, weekly market outlook on the blog section. Thank you so much, guys, and have a great afternoon.
Thank you, Theo. It was another great webinar. Have a good night, everybody, and happy Valentine's.